All right, all right. Good morning, good morning. How's everybody doing in this great, bright, wonderful morning? All right, what are we going to do today? Today we're going to have fun with our UBI, Universal Basic Income Portfolio. How's your Universal Basic Income Portfolio coming along? I've been working on mine very strategically and hard and been doing some back testing, been writing some new articles for you for Pitt News Magazine so you can know a little bit about what I've been thinking and doing and coming up with. And got our team working on it really hard. Already started working on the July issue, if you can believe that. We finished up the June issue and it comes out on the 1st, which is going to be Monday. So we're very excited. It's just putting the final finishing touches on it, making it pretty for you, and it'll come out on Monday. And so we'll look forward to that. I got a lot of really good stuff in the July issue. Also, yesterday we did our day trading and somebody mentioned, hey, I haven't seen Claire's Pitt News Magazine, Pitt News on Air portfolio pop up yet, or what do they call those things? Podcast pop up yet. So I went and checked, and sure enough, it's there. So you can go watch those come out every Wednesday morning, or I guess as of yesterday, it was Wednesday afternoon. I guess whenever she gets them done. But she got one out there on yesterday, and so it's coming along. She's got 4 podcasts now since she just started her new little podcast program, part of Pitt News Magazine. It's Pitt News on Air. And of course, that is on Spotify, but she's got it on, I think she's got it on Apple iTunes now. So you can actually get your podcast. What do they call it? What does she call it? On Air. Podcast Pitt News on Air is now on Apple iTunes. So she hasn't got me an ad for it yet. I got this one. How about this one for you guys? Watch this. This is really funny.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
There you go. We would never use AI to get celebrity endorsements. Never. All right. So if you haven't got Pitt News Magazine, you got something wrong with your brain. All right. That's enough of that. Let's get on with what we're here for. Let's talk about our UBI, Universal Basic Income Portfolio. Now, a lot of people are very concerned about running out of money or having AI take their jobs. I mean, that's really where this UBI acronym came from, right? So everybody's afraid that AI is going to come and take their money. So I've been a strong advocate for people to learn how to trade the financial markets so that you can have your own income source so that you're not worried about somebody taking your jobs. And I've pretty much never had a job, so I don't know. I wouldn't know. I had a job once. I used to work for my dad at the gas station 25, 35 years, 45 years ago. Well, how old am I? 65? Yeah, a long time ago. So, and I haven't had a real job since. I worked in Washington, D.C. For a little while. I had some little small jobs, worked at some computer stores and worked at a Western Auto. That was my dad's. Worked at a Radio Shack. That was my dad's. Worked at a hotel. That was my dad's. Worked at a gas station, 3 or 4 of them. That was my dad's. You know, my dad was a real entrepreneur. You're probably a little disappointed with me. I've only got like 6 companies and he's got like 42. So anyway, trying to keep up with my dad, but he's no longer with me. He's watching me from the other side. And so, you know, always trying to live up to his, always got something to live up to, right? So we're trying to work hard, make some money, but I'm trying to help people make money in the financial market so that they don't have to feel like they're stuck or going to run out of money. And that's a big thing for us who are starting to get a little bit long in the tooth as well, right? We have money to retire on, but we're worried that we might run out of money. So rather than doing that, we just go to the pot of gold here, which is the stock market, and pull some out. Well, it's not as easy as it sounds. Sometimes pulling money out of the stock market isn't as easy as putting money in. Some of us, we seem like all we ever do is put money in. We never take any out. So we have to figure out how to take some money out. And that's one of the articles that's in Pitt News Magazine where we talk a little bit about taking money out of the markets. And I'm not sure. I think Claire did one of her podcasts is about that as well. So the whole idea is that we're going to be working with these specialized ETFs, exchange traded funds. All right. And there's a company out there that's just put these out. They're brand new. I mean, brand new as far as the stock market's concerned. The oldest one that they've got is only about 2 years old. And it's an ETF, it's an exchange traded fund. But what's weird about them and why they're so unique and why they're so awesome, in my opinion, is because they use options to trade and they do a single stock ETF. That doesn't make sense, right? Doesn't make sense. If you know what an ETF is, an ETF is an exchange traded fund. The whole idea of an ETF is that it's supposed to take a basket of funds or a basket of stocks, put them into one fund, and then you trade it with one symbol. So that way you're diversified, right? We've heard that. We all heard that word, diversification. So if you're diversified across multiple stocks, you don't have to go out and buy all those stocks individually. So for example, SPY is the S&P 500. That is actually an ETF, an exchange traded fund, and it's got 500 stocks in it, right? The S&P 500. It's kind of the backbone of the financial markets, the industry, kind of canary in the coal mine. That's the one we watch for the overall broader term market. But it's an ETF. SPY is an ETF, exchange traded fund. And so if you wanted to buy into the S&P 500 in the stock market, you would just go buy that one stock symbol, SPY. You'd buy it. Here, let's pull it up. It's easier to talk about it if we show it rather than tell it. Here's SPY. So we're going to pull up SPY. That is an exchange traded fund. And if you wanted to buy into the 500 best stocks in the U.S. stock exchange, well, there it is. There's the one you'd buy right there. And I couldn't help myself. I have to do it. All right, I have to do it. Look, it broke the blue lights. I told you it would. I said it has to break the blue lights. It will break those blue lights. And it'll usually do it after 3 little drives, right? How many times have I told you that? There's little mountain drive 1, there's little mountain drive 2, there's little mountain drive 3, and it broke the blue lights. Just like a train on rails. Just like in the manual. What manual, Lan? I didn't know there was a manual for the stock market. If you haven't got the manual for the stock market, go get it. It's right there. It's right there. You can get it on Amazon. It's called The Stock Market Playbook of Strategies. And of course, I'm the author, so it's got to be right. And then 238 pages, 8.5 by 11. It's not some little thing like that. It's a big old book, 238 full color. Every single page has color pictures and color charts and graphs. And you can lay it out on it's a soft book, so you can lay it out on your desk like this and put it on your desk and use it as a reference manual. It's not something you're going to read at bedtime at night. It's not a storybook. All right. It's not a storybook. It's a workbook. And unless you plan on working, don't go get it, all right? Because it's not going to, it might put you to sleep at night, but I wouldn't read it at night. That's not really the point. All right, let's get back over here. All right, so that's how this thing works, all right? And so you go get your storybook and you read that at night and you learn how to trade. And so you learn the odds. And what we're really doing is we're trying to get the odds. But you got to take profits along the way, all right? I oftentimes talk about that because what happens if you buy into a market, and this happens to people all the time, right? You buy into a market and it starts to go up and you're like, oh, I'm making money. I'm making money. I'm making money. Oh, I'm rich, rich, rich beyond my wildest dreams. You're so happy. You think that you're going to be, quit your job and be a professional trader. And then suddenly the market starts to come back down like this, right? And then what happens? Well, you got in right here and you got out right here and you didn't make any money. You had lots of beautiful paper profits, right? Market went way up here and then it turned around. It came way back down here. And you just, I'm one of these guys. I'm a buy and hold guy. I just get in there and lay and I'm just going to hang on to it. Okay, well, do that then. And you end up buying here and you end up selling here. And you held on to it for 5 years and it ended up making you no money at all. So what I do is I tell people take profits along the way. Lan, I don't want to take profits along the way. If I take profits along the way, I'll have to pay taxes on it. Well, put it into a protected fund that's not a taxable event fund. Have an IRA or a Roth IRA or a standard IRA or a 401k or, there's all kinds of things that you can do that you can get in and out of markets that don't take taxes. Well, I have my money in an account that makes taxes. Well, all right then, take it and spend your taxes. I'm sorry you had to pay taxes on your $10 million that you made here, but if you did wait and sold it here, well, you saved yourself. You didn't have to pay any taxes on your $10 million. but you also don't have your $10 million because you just gave it all back to the market. Which would you rather have, the $10 million and pay taxes on it, or no $10 million? All right, $300, however much it is. I don't care. If you don't take profits, you can't make money. You got to sell. All right. I can't do it, Lane. I'm a buy and hold guy. I don't have time to sit here and fiddle around knowing when to buy and sell. I just buy and buy and buy. I put money in all the time, but I never take money out. All right, well, do that then. Do that then. That's a strategy too, I guess, if that's the way you want to do it. Well, I'm going to wait until I just put my money in. I'll have $10 million at retirement, and then I'll just start taking some out. Okay, do that. That's a good strategy. You can do that too. You take it out at 65. Most of us are 65. Let's start taking it out. All right. All right. Don't give me your excuses. I know all the excuses. I've made them myself. So there's this really cool fund called an ETF, exchange traded fund, basket of funds. Another company comes out, creates exchange traded funds. What do? They put one stock in it. That's dumb. Why in the heck would you put one stock into an exchange traded fund? Why wouldn't I just buy the stock itself? Well, you can do that. But this exchange traded fund, what it does is they take the one stock, they take it and put it into the fund, but then instead of just buying the shares, they trade it with options. And they do kind of some fancy stuff in there, covered call strategies, naked puts, they do some longs and some calls and puts and long positions and short positions. They trade those funds with options. Now, if you're an options trader, and I'm not going to go into all the advantages of options in this class, just know that they're going to trade your money with options. All right. So it's actually not trading the underlying stock in the way that you might think. All right. You're going to give them your money. They're going to put it into this fund, and then this fund sits there, and then they're going to trade the options on the underlying stock. So let's go in, and it's easier to show you than it is to tell you. Let's come in and do one that's been real popular lately, which is Tesla. Most people know what Tesla is. Here's Tesla. All right. Elon Musk, and he makes electric cars. And this is his electric car business. Now, they don't only make electric cars. They make other things too. They make robots, and that's something that's supposed to be making him some money. They also make power walls, right? So they do electricity type things for your house and businesses and corporations and computer systems and computer houses. They also, of course, he owns Twitter, but that's not part of Tesla. But we all know Elon Musk and we all know Tesla. So they have kind of a unique line of products, but nonetheless, they've focused mostly on electric cars. And so as we come in here, if you want to buy Tesla, let's get rid of some of these drawing tools. Oh, we got lots of lines in here too. Let's fix that too while I'm here. Let's come in here. We're going to go into the chart preferences tab, and I'm going to make this go to 50. Boom, just like that. Fix it just like that. That's how you fix it. Let's make sure while we're in here that we got everything else set up the way we want. Come down here to your price bars. Here, let me grow this a little bit. I'll do the best I can to make it bigger. All right, so come down here when you got track and trade. All right, these are all your default settings. How you get to this, you right click on the chart, come down here to your chart preferences tab, just like that. All right. Now, if you don't have track and trade, go get it. All right, here we go. Go get it over at, now I'm in the way again. Go get it over here at trackandtrade.com and then download your software. If we're going to use the futures version, that's one we use to day trade with. I like to day trade futures. You don't have to day trade futures. You can do position trading, all kinds of futures trading out of Chicago. You get that one. We'll trade that one on Wednesdays. Today's not Wednesday, it's Thursday, so we're trading stocks. That's the stocks version. So there's two versions of the track and trade software. That's the ones I use. Go get these and you can follow along and I'll give you all my settings. All right, so here, look at this. Let me see if I can get that off the screen. How do I get it off the screen? Oh, there we go. All right. They've changed these things all around, and now it's really screwy. I don't know.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, how's that? That makes it easier. Okay, so now these are my settings. Now, when we come down through here, what I want to do is I want to show you something. In your software, that's where you change these background lines. Sometimes they get screwed up because you got different charts have different pricing, and you have to kind of adjust them sometimes. So this is a price scale, and I just do that right here. You can have fixed scale like that, but I don't like that. I like it like this. All right, I like to tell it which one. That's on a monthly, beginning of the month. That's a monthly chart. No, that's a daily chart. So we're working up here with daily chart right there. Okay, daily chart. Okay, so our daily chart, these are the settings for our daily chart. Now, I want to show you something. Come down here and always make sure that your price bars, if you're using candlesticks, like I use candlesticks. Now, I use bulls and bears, so a lot of times that covers up some of this mathematics of other parts. But always make sure your color is open to close. All right, open to close. Check that in your track and trade software, because sometimes it starts out as close to close like that, and you don't want that. And sometimes it's got alternate days. You don't want that. You want open to close, and make sure yours is on open to close. All right. Now I change the colors and I make it fill candles. That's how I do it. So if you want to do what I do, that's what I do. All right. Open to close. All right. And then hit save as my defaults, update all charts, and then everything should be copacetic. All right, so now we come back over here, and we're talking about Tesla, and Tesla is an individual stock. All right, and you can trade Tesla however you want. You can come in here, you can buy shares, you can come in here and you can trade options on it. You can do all kinds of fun things. But one thing about Tesla is that it doesn't have dividends. No dividends on Tesla. He doesn't give you dividends. What are dividends? Dividends are a way of taking profits along the way. Now, I just talked about that. I think one of the best ways to make money in the financial markets is as you start making money, take some off the table, right? Take money off the table. Now, I can't help myself. I have to do it, even though this is not part of today's class. Look at this. This is our natural trend line. This is our first drive. This is our A drive coming off of our where is it? Oh, I don't have it on my desktop. I wanted to show you. But nonetheless, here's our three little drive pattern. Drive 1. Drive 2, drive 3. All right, Mark Peterson, if you're here, that's what you came here to learn. I was talking to my buddy Mark this morning. He says, I want to sneak some ideas off of you about how we can do this over in the futures market. What you're doing is you're looking for your drives. Get your bulls and bears turned on so you can see where the overall longer term drives are. That's going to tell you that's going to be the longer term drives. But then you have your natural trend line, and then we get 3 of these little mountains in here. All right, and then once we get that, usually this market will come back. It'll break those blue lights, and then it'll come back, and that's where we use our Fibonacci ruler to come in here with our Fibonacci ruler. We line that up. We don't know where Tesla's going to go. Still got one more little mountain here to make. It's doing it right now. So this is the first one. That's the second one. That's the third one. And then it'll come back. And usually it comes back off of there to at least 38.2. All right, 38.2. And then it might start to go back up again, and it'll break those blue lights. The blue lights will come in. You'll intercept your blue lights right up in here across the top there. And then it'll start to go one more time. That'll get you going into the second drive. All right. Now, this is the A drive. That would be the B drive. In the futures market, it's not as common to see the C drive. We don't get as many of those. A drive, B drive, C drive. We usually get A drive and B drive. We don't get a C drive. Not that it doesn't happen, certainly does. It's just not as common as it is over here in the stock market. In the stock market, we get a lot more C drives. Now, this is the A drive. So, and then in the A drive, you have 3 little drives inside of the A drive. So this one down here, this is what we call the A drive. So this is the first little mountain beginner. This is the beginning of the second little mountain, so we call it A2. And this is the beginning of this third little mountain, so we call it A3. So that's how that works, all right? So then it's going to break those blue lights up in here somewhere after it gets done making that third little mountain. And then it'll turn and it'll come back down, break those blue lights, and then it'll turn and start to go back up. Now, 38.2 is a really popular number for the market to come back to, touch that, and start to go again. If it's a strong market. If it's not, it'll come back down into the full delta cone of probability, which is this number, this little spot right here. I call it the Fibonacci sweet spot. All right, but it's the delta cone of probability. Markets have a tendency to go to the 1 standard deviation, right? So this is the 1 standard deviation of the first drive pattern. It'll come back in here. Now, there's 2 Fibonacci numbers in here. There's 38.2 and 61.8. Those are our two Fibonacci numbers. 50% is not a Fibonacci number. It just happens to be between 38.2 and 61.8, so we put it in there. It actually ends up being, this is just kind of, I call it the Fibonacci sweet spot. So the market comes back down somewhere inside this circle, turns around and goes back up, all right? That's the idea. That's the name of the game. Count and measure. Count and measure. Setup and trigger. What's the setup? The setup is looking for the pullbacks. The setup is for looking for the pullbacks. The setup is looking for the pullbacks. What's the trigger? Well, when you draw your little natural trend line across there, when it breaks that trend line right there, breaks that trend line, that's your trigger. That's an entry point right there. That's where you get in, going into the second little mountain. All right, the third little mountain. Then the overall longer term drive, you got your little pullback in here. This would be the A1, or this would be actually B1 because you're going into the B drive. B1, breaking of that trend line, that's your setup, that's your trigger. There you go. Get rich, rich, rich beyond your wildest dreams. Now, the part that I'm talking about today is getting out of the market, taking your profits. We also have little profit takers in here, all right? So we don't generally talk about getting out of a market on the A drive on each one of these little drives right here, but you can. And maybe in the futures market, you might want to do that because this would be like a big amount of money in the futures market. But you don't necessarily get out here. We just get out when the market crosses those blue lights. So we call that X. X for exit. I could call it exit, but I just said X. Hope it translates. All right, exit. Exit, that would be your exit 1. So exit 1 would be when the market crosses those blue lights. So you get in here, right? You get in here on an A1. It's hard to get in on A1 sometimes because we don't know when they're going to start. So generally we get in on the A2. So we get in on the A2, and then as it goes up, we A3, and then we get out at the exit. That's our profit. And then we go and we get in here and we do it again. And then we get in right here. And B1s are always good. We can get in on B1s. We miss the A1s. We don't try to chase the A1s. Sometimes we're not sure where they're at. But they were a little bit more clear on some charts, a little bit less clear on others. All right. So then we get in here, and then we have an exit 2 at the top of the B drive. Okay. So you add on to your position on A2 if you got in on A1. And then A3, you can add on to your position. I wouldn't take a new position on A3. It's a little bit toppy up in there. So, but this is where you got to get out and take your profits. If you don't get out and take your profits, the market has a tendency to flush and come all the way back down. If it doesn't bounce off of this one standard deviation and go back up and just keeps on going down, you're going to lose all your money. So you got to get out. You got to get out. The only way you can make money is to get out of the market and take your profits. All right. So that's just a quick rundown on Tesla. Now we're going to come over to our single stock ETF, which is TSLY. All right. Now, Tesla does not give dividends, and dividends is a way of taking profits along the way if you're going to be one of these guys that holds forever. All right. So buy and hold and then take profits along the way. Well, you can't take profits along the way if you don't sell out your shares. Well, I don't want to sell out my shares, Len. I want to collect a big bunch of shares and have a big pot of gold at the end of my life. Okay, that's nothing wrong with that. It's just a different strategy. Okay, I kind of lean towards this strategy. Actually, where's TSLY? Right here. So here's TSLY. We counted these all the way down the trend, so you count them down just like you count them up. But here's when we come in here, this is where the market started to go sideways, and this is starting to bounce and go back up a little bit. It's not quite as well formed in its trends, you see, as is Tesla. See how nicely Tesla, let's get rid of these drawings. So you see how nicely Tesla's trending back up with its nice little patterns? Well, you're going to get that in the Tesla. In the TSLY, you don't get quite as pretty of a pattern. Why? Because they're taking their profits along the way. And anytime you take money out, well, you degrade what we call the NAV, the net asset value of your stock, right? Or of your portfolio. So if you're going to start taking shares out over in the Tesla, well, you're going to degrade your NAV yourself on the way out as you take profits along the way, right? You got to take profits out eventually, even if it's at the end of the world, end of your, when you're 85 years old and you decide it's finally time to take some money out of the stock market, you start selling off shares. All right. That's degrading your NAV. All right. So everybody's worried about NAV degradation. Well, either side of the coin, whether you're going to trade in the TSLY, which is the single stock ETF, which is being traded with options, or if you're going to trade over in Tesla, TSLA, that one if you want to take profits, you have your shares, you're going to have to start taking shares off. Now, it doesn't degrade the chart because they're not taking shares off, but you're degrading your account. As you take shares off, you're taking profits out of the market, so you're degrading your own NAV. So people are all concerned about NAV degradation. Oh my gosh, I can't trade these Tesla charts. They have NAV degradation. Well, of course they have NAV degradation. They're taking profits along the way. And that's the whole idea of this concept, taking profits along the way. And I've talked about this my whole life. You got to take profits along the way, because if you don't take profits along the way, you could make a whole bunch of profits just to give them all back and end up with nothing, right? Which we talked about. So today we're talking a little bit about our Tesla fund here, and in particular, and a bunch of them, there's a bunch of them that you can do this on, and this company's come out. The name of the company is called YieldMax. And if you pull up the YieldMax website, which is right here, I have it right here. YieldMax ETFs. Hold on a second, I'm losing my voice. You guys are all trying to get my attention. When did the audio go off? John's madder than a hornet. Kirk's trying to wave at me. Kirk's like, your headset's not on. I hate it when that happens. That's been a while then, hasn't it? I hate it when that happens. I hate the software for that reason. At one point, I was like, I'm never going to use that software because it turns the microphone off on you. It did it automatically. It turns the microphone off automatically. And then I have to turn it back on manually. So it's been off for about 10 minutes, huh? Well, that's good because all I did was pontificate forever. Oh, geez. All right. So to continue with the summary, we are looking at two different stocks. One is the PLTY, which is the single stock ETF, and one is the PLTR, which is the actual stock itself. So the PLTY is a derivative stock. It's like a single stock futures. For those of you who remember back in the good old days when we had single stock futures, this is a single stock ETF. Now, I'm not familiar with any other company who's ever done this before, but if you are aware of somebody who's done single stock ETFs before, let me know. I think YieldMax is the first company that's ever done that. I don't know. But I think they are. And so this is why I'm a little bit enamored with them. I like what they're doing because we used to do this over in the futures exchange with single stock futures. And that didn't last very long. So now we're doing it over here in the stock market with single stock ETFs. It's basically the same concept, but we're using options to trade them with. So if you think about an options basket, for those of you who know and understand how options work, you can trade options without actually putting your money into the account. That's what an option is. So if you're going to sell options, now the way these guys do it is they do long calls, which of course they take your money away for that, but they take your money away. But if you sell an option, they give you the money immediately. So that's what they do. They come in and they buy a call and they sell a put at the same time. And that gives you what we call a free trade. So they put the money in, they take the money out. So there's no out-of-pocket cost to what they're doing. But then the market is basically a synthetic long position. Then they sell a call against it to collect the premium. All right. So then when that premium of that option expires, that profit goes into the PLTY fund. So if you think about PLTY, it is not actually, what you're actually tracking is not the underlying stock so much. I mean, you are, because that's what the market's being invested in. That's the value of your options, right? But what you're really doing is think about this as just your cash account for your options trading. All right, that's what it is. That's how Palantir that's how YieldMax thinks of these funds. PLTY is actually just a bucket of money over here that they use to guarantee their options trades, which are selling options. That's how they make money. So they don't actually take the money out, right? It's just a guarantee. So the money sits over here in the bucket, and that's what you're watching. You're watching the value of the bucket go up and down. Now, if you put more money in, let's say you want to invest in PLTY, you put money into that bucket, well, the bucket's going to rise in value. If you take your money out, the bucket's going to lower in value. It's just, think of it as your cash account. Just think of it as a bank account. It's a bank account. You put money in, the value's going to go up. You pull money out, the value's going to go down. Now, there's other things that will work on that. If they sell some options, they're going to put the profits into the bucket. The bucket will go up. All right. And you're like, well, it kind of follows Palantir itself. Palantir has basically the same patterns. Well, that's because they make money when Palantir goes up. So they put more money into the bucket. And then when they want to take money out, this is one of the things, when Palantir goes down, they don't make as much money. So the bucket can go down too. But the thing is that the market rises. And then see this big thing right here? This big yellow dot, this big yellow part right here, this flush out. I did a video on this. If you haven't seen it, it's over in the video section, not in the live section. But that's where they took money out of the bucket and gave it to you as income. Okay, gave it to you. So they're taking profits along the way. So that's the whole idea. And we talked about taking profits along the way. I don't know if you caught that discussion, but that's the whole idea of why, when you're doing it over here, you're taking profits along the way. You buy in down here, you sell out up here. And all these little circles that I was drawing is where I'm buying back in as the market falls back down through this trend. All right. So you buy here, you sell out by the time you get up here. This is the accumulation distribution model. And then when it comes down here, you're buying back in, buying back in, buying back in for the next rally up. So that's how that works. And then when you come into PLTY, well, it's a little bit different game. You don't buy and sell into PLTY. This is a buy and hold strategy. All right. And the reason is because this is just a cash account for Palantir, for YieldMax, who's going to trade options on the underlying PLTR for you on your behalf. All right. They're going to trade these option strategies for you. Now, if you like to trade options yourself, you just go into PLTR, do the same strategy, run it yourself if you want to. But if you're like, damn, that sounds like a pretty good strategy, but I don't want to run it myself, can I hire somebody to run that for me? Yes, you can. You can just give it to PLTY. They will trade those option strategies for you. And this is how they do it. And then this becomes the cash account that you're tracking. You're tracking the value of your cash account. But they take money out of it all the time and hand it to you and put it in your back pocket. So it's no longer in PLTY. This is the part that most people don't understand. This is why they complain a lot about this out on the YouTubes out there about NAV decay. Oh, I hate these things. They've got NAV decay. Well, of course they have NAV decay. Anytime you take money out of the market, put it in your pocket or go spend it, pay your bills with it, it's called NAV decay. Whether you take it out of, whether you sell your stock, right? If you have a whole bunch of stock and you sell some so that you have the money to go pay your bills, well, that's NAV decay in another way. All right. It's NAV decay of your account. Well, if you think of PLTY is just your cash account, that's all it is. And the whole idea of these cash accounts is that they're going to take the profits out and give them to you so you can go spend them or reinvest them somewhere else. I mean, we do that too, right? But PLTY is just a cash account, and this is a distribution right here. So it's not loss. Nobody lost money there. This was a distribution. Anybody who held this, they took the money out of the cash account and gave it to you. So all they did is take it from your left pocket and put it into your right pocket. Problem with your left pocket is that you can't go buy candy with the money that's in your left pocket. You can only buy candy with money that's in your right pocket. So they take the money out of the left pocket, which is PLTY, and they put it into your right pocket. Now that it's in your right pocket, you can go buy candy. All right. And you're like, but Lan, I'm worried about how much money's in my left pocket. Don't I have to worry about the ups and downs of my left pocket? Well, no, because this is the cash that they're going to use in their business structure, right? You're an investor in a business. They're going to use that money to trade PLTR with. Now, how good of traders are they, right? That's what they're doing. They're trading options on PLTR with your money. You gave them money, put it into PLTY. Now they're going to take that money and they're going to trade it with options on PLTR. If they make money, they put it back into PLTY. PLTY will go up in value, but then they take the money out, put it into your right pocket. PLTY goes down in value. Why? Because they took the money out. It didn't lose money. They took the money out. Now, they could not make money because they're trading the money. And if they don't make money, because it's a long position, this PLTY makes money when the market goes up, because stock market generally goes up, right? So PLTR, if PLTR has a bad day and it goes down like that for a long period of time, well, these guys are trading options on it. They're not going to be able to make a lot of money in that time frame, so their left pocket of money is going to go down too. But they still pulled money out during that time frame and paid it to you, so that caused it to go down too. So that accelerated the downtrend. So you're going to see accelerated downtrends. If their PLTRs having downtrends, you're going to have an accelerated downtrend over in PLTY, because not only are they not making money because the market's going down and they're doing covered calls. Now they're making money on their covered calls, but they're taking that money, putting it in there, and then they take it out and give it to you, and then the market goes down too. So it compounds your downside. So oftentimes what we say is be careful with the drip. I always tell people, don't drip your dividends back into your fund. Never drip. Never, never, never. If you got drip turned on, if you're investing into any of these funds, even some of the slower ones like AT&T and some of these that have dividends, don't drip your money. Don't drip it. Don't ever drip. That's a bad methodology. You want that money to come out to you, go into your cash account, and then use it and think about it in your brain as new capital that you can put into the market somewhere strategically. Buy low, sell high. And generally, when they pay out the market, right, you don't know whether the market's going up or down at that point, and it's just going to automatically throw it back in. That defeats the purpose of why did they take it out and give it to you. Defeats the purpose. The purpose was to take it out and have you strategically use it for some purpose, whether that's to go buy candy, pay bills at house, or buy food, or to reinvest it strategically back into the market. If you're just going to drip it back into the same damn thing, why'd you even take it out in the first place? All right. So never drip. Never, ever drip. So especially with these yield max funds, because if you start dripping in like here and the market starts to go down and you reinvest, all you're doing is compounding your losses. And you don't want to do that. You don't want to compound losses. So you want to be very, very strategic about it. And when the market's up in here and they start giving you dividends and it looks like this market might be in a pullback state, wait. Don't put your dividends back in. Wait. Use that money. Think of it. If you're going to reinvest it, think of it as new capital, money that I went and worked at McDonald's for, and they gave me a paycheck. Now I have a paycheck and I'm going to put it in the stock market. Where am I going to put it? You want to be strategic about it. Are you going to put it in when the market's as high, it looks like it's going to have a pullback? Or are you going to put it down, buy low, sell high? Or are you going to buy high? If you're dripping, you're probably buying high. You don't want to do that. It's going to compound your losses. All right. So be very careful with your drips. If you don't learn anything else about this thing, and even those of you who stuck around after I had a long dry spell of no audio, and you learn anything, one thing, if you learn one thing, don't drip. Never drip. It's a nasty, nasty, bad habit. It's like chewing tobacco. I know you love your chewing tobacco, but man, it's a nasty habit. Ugh, gross. But you love it. I know you do. But it's a nasty habit. Don't dripping your dripping your dividends back into the market is as nasty as chewing tobacco. It's a nasty habit. All right. Don't do it. Think of it as new capital. Okay. So that's the name of the game. So now let's go through, and now that we've studied a little bit about these dividends and how they work, and how they are kind of a separate thing, but the same thing as the underlying, but they're the ones who give you the dividends, and the dividends come out. So that's why the market falls. It's not losing money. It's just taking it from left pocket, putting it in right pocket. So now we're going to come in and we're going to look at our spreadsheet. So our spreadsheet is where we've been tracking, and we've got a portfolio of our own trades. So for us, we put $50,000 into YMAG. YMAG is one of our yield max funds. All right. So we come in here, we type up YMAG. There it is. There's what YMAG's been doing. Okay. So YMAG is going up that nice little trend line, just like that. Now, whatever you've got into YMAG, you probably don't want to pull it out. Not if you have any kind of futuristic idea that YMAG is going to go up. All right. Now, if you think YMAG is going to die and just tumble and not come back, you certainly don't want to be investing in it. And some of these funds, they actually have short positions on. But I'm going to tell you a little side note, little sidebar. They've got like five funds that are for short positions. And believe it or not, I did a lot of back testing, comparative back testing. And some of those results are in articles in Pitt News Magazine coming up. So be mindful of that. But I've done a lot of back testing, and I back tested the short positions of the yield max short strategies. In fact, let's go look at them real quick. It's easier to show than it is to tell. Let's go over and show it. All right, so here's our yield max funds. We're going to go in our ETFs, and I'm going to come in here. Oh, come on. I don't need all your animations. I'm done with animations. All right, so we're going to come in here, and we're going to come down and look. They got short option income ETFs. 1, 2, 3, 4, 5 of them. They got crush. So if you think Tesla's going down, the idea is to buy the short side, right? Buy into CRSH. Fiat, that's for coin. Coin is for those of you who don't know, it's like an exchange, if you want to call it an exchange for cryptocurrency. I'll admit, I'm not a big crypto guy. If you have questions about crypto, don't ask me. I own some Bitcoin. I have some Bitcoin. I've been in Bitcoin. I've been involved in Bitcoin, did the mining in Bitcoin. I just have to admit it. I'm not that good at understanding all this currency stuff. So don't ask me. And then NVIDIA, this is DIPS. So NVDA is the underlying for that one. So if you think the market's going to go short, you could make money on the short side. So what they're doing is they're selling covered puts is what they're doing. So then YQQ, if you think the NASDAQ is going to flush, you could buy YQQ and make money on that one. And then MSTR is WNTR. All right. So that would be on the way down for MSTR, which is the long side is Misty, which is one of my favorite stocks. I like, well, I don't know. I have a love-hate relationship with it. I made a lot of money off of it, but it's really volatile and it's all over the place. So if you get into Misty, you got to be real careful. All right. So as we come in here, those are the short ones. Now, I've done a whole bunch of back testing on them. Now, there's not a lot of back testing history. All right. I have to admit that. But we did have a big drawdown in the market. One of the biggest drawdowns that we could test them against. And all of these were active during that big drawdown. All right. So if we come back over to our charts, we know that there was a big drawdown right through here, YMAG, right? That was a big drawdown. I did back testing, and none of those did very well. Those short positions did very well, even during the big drawdown. They weren't big enough drop. That wasn't a big enough drop for them to make money on. Now, again, granted, there's not very much history. It wasn't a very sophisticated back test, but the back test was not very positive for those short positions. And I also did some other back testing where I went in and I did a long and a short. All right, because we talked about that in class at the university. Brian, if you're here, I did a bunch of back testing on this where we would, the idea, you're thinking, well, heck, I got an idea. What I'll do is I'll go in and I'll buy the long one and I'll buy the short one, which will cancel out the NAV. So if the NAV goes down on one, it'll go up on the other and up and down. So I'll have flat NAV and I'll just collect the premium. And so I thought, well, that might be a cool idea. I'm going to do some back testing on it. I didn't really do it myself with real money. I was like, I'm not really comfortable with that idea. Buying and selling two single stock ETFs, one for long side, one for short side, to cancel out each other. That's the idea. Cancel out the NAV loss, right? And then just take the dividends. It sounds like free money. Doesn't work. I tried it on every single one of them. Tried to do back testing to see if I could get that idea, that concept to work, and I couldn't get it to work. It didn't work at all. Not once could I get it to make money. So don't do it. Don't do it unless you're more sophisticated of a trader than I am and can figure out how to make money. I couldn't make the shorts make money by themselves, and I couldn't make shorts make money in the short time, just in the very small back test. I'm not slamming them too badly, but I couldn't make the shorts make money no matter what I did with them. So in the back testing, historical back testing, I didn't do a real time on them. So, and there's, in my mind, I have a reason why that might be. The thing is that when you do a covered put, and you'll notice that that's very rare. Most people don't do covered puts, and selling puts is a difficult thing to make money because they don't decay as fast. And what's funny is we have what we call a call puts skew. And so I think it's the skew of the put options. And I'm going to have to do a little bit more research on how to really frame this. I think I wrote an article on it in Pitt News Magazine like 3 years ago. And I think I need to readdress that article, bring it forward, readdress it now with the new concepts here. Because 3 years ago, we didn't have the YMAX. We didn't have the yield max funds. So I want to go into those with that mindset and readdress that article on the put, on the put degradation. There's a skew between them, and I need to go in and articulate that a little bit better for you. And I think that's the reason why the short positions are not working. Now they only got 4 of them or 5 of them. What did I say? 4 or 5. Anyway, stay away from them. That's all I'm trying to. I hate to say stay away from yield max funds because I love the yield max funds. There's almost none of them that I'd stay away from, but I'm staying away from the short ones. I'm staying away from the short ones. You guys can do what you want. I'm not telling you what to do. I'm just telling you what I do. What I do is stay away from the short ones. I tried a bunch of back tests. They don't work. I couldn't make them work in the back test. Well, we just got a short amount of history, so take it with a grain of salt. But don't do that hedging thing. That doesn't work. All right, so let's come back in here and go back over to our spreadsheet. We got to see if we made any money because we've had a couple of payouts, I think, and we can go see how much money we made. So we start off, we got $50,000. Let's bring this full screen. $50,000 in YMAG, and let's go look and see when it paid its dividends. Right here. So we're going to pull up YMAG. Track and Trade doesn't do dividends, and so we have to use this ding-dong little online tool, and it does dividends. Now, YMAG, notice that YMAG gives dividends. It pays out. It takes profits along the way every week, and that's really cool. So it pays you every week. And why is that cool? Well, it's cool because you can then compound your money if you want to reinvest it every week so that you don't have to wait a whole month. If you wait like AT&T, if we go into AT&T to get your dividends, they pay quarterly. Look at that. Oh, where is, oh, there's AT, there they are. So see that little circle? That little circle is your dividends. It's 27 cents per share, which is not bad. You have to give them credit. That's pretty good for a normal stock. It's one of the highest paying dividends in a normal stock that there is. So 27 cents for every share you have, and a share is $27. So, but they don't give them to you. They only give them to you every 3 months. Okay, every 3 months. So you can only recompound your money every 3 months. Well, look at YMAG. If you come in here, YMAG, they give you your dividends every week, and it's 29 cents. It's more money than AT&T, and they give it to you every week. And the share price is only $15. What was share price on AT&T again? Can't remember. 50, was it 50 something? No, 27. So it's $27 quarterly. You get 27 cents on $27 quarterly. On YMAG, you get your dividends every week, and you get 29 cents on a share price of $15. That's pretty cool. Compared to AT&T, that's really cool. All right, you got to admit, that's really cool. Every week you get 20, what? Not every quarter. Every week you get 29 cents on the share price is only $15, not $27, and not 27 cents every quarter, every 3 months. That's cool. I don't know. Maybe I think it's cool. I think it's cool. I don't hear anybody in here. Nobody's clapping. Nobody's applauding. That's really cool. But you think that's cool. Look at this one. We were talking about what was it? Misty, MSTY. You think that this one's cool? Look at this one, Misty. Now it only does it every month, but look at that, $2.37 on a $21 share. You buy a $21 share, they're going to give you $2.37 every month. That's pretty cool. Don't you think that's cool? I think it's cool. Now they're taking money along the way. This is how you take profits along the way when you're not disciplined to do it yourself with your shares. And the thing is you're not going to liquidate your shares to do it. So if you go over into Tesla, TSLA, and you say, I got $1 million in Tesla, or I got $100,000 in Tesla, or whatever it is, and then you go into Tesla and want to take profits. How do you take profits out of Tesla? You have to sell some shares, right? You have to sell some shares. Well, this way, if you have all your money sitting in Misty, you don't have to sell your shares. They just give you a big chunk of dividends because they're trading options on it and collecting premium. They're doing the covered call strategy for you on your behalf. And then you just this money that they're giving you are covered calls. That's where they get their money from. They're not getting their money from the growth of Tesla itself, so you don't have to ever sell your shares. You don't sell your shares when you go into Misty. Now, there's times when you might want to sell your shares, all right? But that's beyond the scope of today's class. But it's buy low, sell high type of stuff. So you just simply want to be strategic about where you move your money, right? Be strategic about it. And it's a little bit more of a money management process as opposed to buying and selling for profit, because that's not what we're doing. Because this is just a bunch of cash accounts. If you think about it like that, everything that's in the Yield Max fund is just a bunch of cash accounts for trading options in those individual stocks. And then they just take the money out, put it into the cash account, and then every month they give it to you as profit. They hand it back to you. And it goes from your left pocket to your right pocket. And then you can either put it back in if you want, but don't drip. Just make sure you're buying low, selling high. Buy the dips, right? If you're going to put money back in, you're like, well, I want to compound land. Well, have 4 of them and compound from one into another, into another, into another. I do that sometimes too. So now you're compounding these ones that pay out monthly. You can compound them weekly because you can go take your dividends from Misty because you're not going to drip them, right? Take your money out from Misty, put it into Palantir. Take your money from Palantir. When it comes out, put it into Microsoft. Take your money from Microsoft, put it in NVIDIA, and then start the process all over again. And you can just keep moving your money, and you can take this money and compound it like that, and compound it every week, compound it weekly. But that's what these monthlies you can do, or with the YMAG, that's how they do it for you. They're giving it to you. They're giving it to you every week so that you can take that money and compound it weekly itself. That's why they're doing that. If we give them their money every week and not make them wait a whole month, they can compound it every week. Now, I wouldn't drip it. Don't drip it back in, but be strategic about it. So $50,000 is what we put in. All right. And let's see, the current value, we have to do the dividends most recent. How much did they pay out on YMAG? So let's go back to YMAG. The most recent was 29.3 cents. So we're going to put that in here, 0.293. And we got 50,000. How many shares do we have? We have 2,630 shares. When was the last time we recorded our dividends for YMAG? Last time was May. So we had 265, 278. Let's go back over. So 2 of them in May. And this is May. So this one, May, is this May? Oh, 1, 2. Oh, we got 3 dividends we get to count. So we've got, oh, goodness sakes, this is going to take me a minute. So we've got 1 dividend. So we only did 2, and we got 1. Look, in May, we're going to get May 1st, May 8th, May 15th, May 22nd, and May 28th. Woo! We got 5 weeks in May. We already recorded the first 2. So this one is May 15th, and it was 0.20. I'm just going to write these down. And then this one was May 22nd. This is for our spreadsheet. You have to track it like this because they don't track it like this for you in your little account. So now we're going to have to come in here and 0.26. And that one was for the 22nd. And then on this one, they paid us how much? 29 cents. 0.293 cents on the 28th. That's pretty cool, right? So now what we're going to do is we're going to go and go back over here. How many shares did we say we had? 2,630. 2,630. So now I'm going to take my little calculator, and I know you're saying, Land, this should all be in the spreadsheet. Why isn't the spreadsheet doing this? Because if you're tracking your real money, this is already done for you. This is the part that the your brokerage firm does for you. So if you have these numbers are already given to you. It's just that this is a simulated account, so we have to calculate these ourselves. So we're going to come in here, and very simple. We're going to take our 2,630.19. And we're going to times that by 0.20. So they gave us $526. $526.03. Don't forget the 3 cents. And then the next one, they did 2,630.19 times. And then that one, they did 26 cents, 0.26 equals. So that month, that week, they gave us $683.84. How about that? And then on this one, we did 0.293 times 2630.19 equals. So that they gave us $770.64. That's pretty cool. Let's go put that into our spreadsheet. All right. So in the month of May, we already have the first two. We have 265 they gave us, and then 274.8. Then they gave us $526.03. Then they gave us $683.84. And then they gave us $770.64. How about that? So for the month of May, wow, they gave us $2,524. That's the biggest month we've had. Well, of course, that's because so that means June's going to have a smaller month. Oh, no, maybe April was the smaller month because we pushed one of those into May. Maybe April will still have four payouts. We only had three. Did we only have three payouts here? 1, 2, 3. No, we had 4 payouts in April, but we got 1, 2, 3, 4, 5 payouts in May. That's cool. That's awesome. Let's get rid of this for a second. Hide. All right. So now that number goes over here into our YMAG. See right there. So in the month of May, out of YMAG, we made $2,524 on our $50,000 investment. Now, if we put anything else back into YMAG, or are we still at, now this is our seed money right here. No, we still only have $50,000. So we put $50,000 in on 1/1, and so now we're into May. And so far this year, on our $50,000, they've given us $7,400 in dividends. That's really cool. All right. So that reflects over here. So May, Microsoft, we already counted that one. That was MSFO. We got $14 because we just got a small amount. In that one, we just reinvested some of our dividends into Microsoft, and just to do it that one day, remember? And we put $500 in. $499.07. That's what it ended up with. And then payments received, we received $52. And this is remaining seed. They owe us still $446 to get back to break even, right? And then we got paid back so far, they paid us back 10%. So YMAG, they paid us back 14%. So we've received 14% of our money back. And that's what we're looking for. I call those cash cows in the gravy train. So once we get back all of our money, we got $42,000 left. And it'll take them 1.15 years to give us all back. Once it's all back, yes, I do. Rock's asking, do you have this in your real money account? If you wait, I'll show you my real money account here in just a minute because I'm making different changes. So I have my normal account, I have a Roth IRA, I have a standard IRA, I have a SEP, and I have a, what do they call those things? I don't know. They call them something for insurance. So when you buy aspirins, you can go take money out of it. So I got 5 accounts. Now I don't have all 5 accounts focused 100% on yield max funds, but a large percentage. I have about $1 million in real money, Rock, in these yield max funds. And I started trading them back in July, and I did a back test. And since July in the yield max funds, my personal accounts, all of them combined, I've made about $256,000 in dividends. That's how much I've made, about $256,000 in dividends across the board profit. So yes, I have real money in these. I'll show you my real money spreadsheet because I've given you this spreadsheet. Everybody who is a member of Pitt News Magazine, if you have a subscription to Pitt News Magazine, every time you get Pitt News Magazine every month, it's got a link to this spreadsheet. So you can download it and convert it to your own use, right? So you can track. You have to track them because your little. I mean, even track and trade, right? We don't track it. If you go into track and trade, in here, we don't track your dividends. We don't track all that. We don't add all that up. It's done for taxes, and it's not done for so you can know what your profits are. They just do the math differently. So the math is done differently of all these accounts. So if you want to track this the way I like to track it, which is for cash cow, what I call the cash cow, and so run it like a business. All right. So if you make an initial investment into your business, you want to know how long it's going to take before they pay you back, get your money back. And then after that, it's all what I call cash cow. You're on the gravy train. All right. So you become a cash cow in a gravy train. If you put 50,000 in, how long is it going to take them to give you 50,000 back? Once they give you the 50,000 back, well, you have no out-of-pocket risk. At that point, you have a cash cow and you're on the gravy train. So that's how I'm tracking it. And then I like to know how much I've received from each individual stock, because if you go into here, they just include it in the balance. So they don't ever break it out for you. And so I like to track it. I like to do a little bit more math than what the normal brokerage firm does. And so that's what this little spreadsheet is. And I'm modifying this spreadsheet. I'm making a better one. I think I'm making a better one. I don't know. It's just different. I don't know if it's better. It's just different. So I'll show you mine. Because the one I'm doing, the new spreadsheet, is for my real account. I haven't made a demo account for you guys yet, or one that you can take and modify for yourself. I'm going to do that, and that's on my, so when you, because you're a member of Pitt News Magazine, I will email you the new spreadsheet when I get it. But I'll show you the spreadsheet. I pull it up when I'll pull it up. I don't have a problem showing you my real money accounts. All right, so we're going to come in here. And it's not working complete. I'm still working on it. So that's why I haven't given it to you yet. It's still broken. Still got problems with it. The spreadsheet is not complete. I've spent weeks and months and months working on it. And I'm going to give it to you for free just because you're a member of Pitt News Magazine. It's months of my work, all right, to create these spreadsheets. All right, so now we're going to come in. Let's do the next one. So the next one is NVIDIA. And we've only got $5,000 in NVIDIA. And NVIDIA went up a lot. But we don't really care about the NAV. I mean, we do. We care about the NAV, but we're really more interested in the dividends, right? How much money our money's making us. So we got 5,000 in there. How many shares do we have? 290. Let's go back over to NVIDIA. Well, let's wait before we do that. Let's see. When was the last time we recorded NVIDIA? Tesla is the next one on our list. Let's go do Tesla instead. Tesla is the next one on our list. We already did Misty. So we got Misty for the month of May. We already got Misty $4,595. Tesla is the next one on our list. So let's go see how much we have in Tesla. Tesla, we have $54,539, but that gave us $3,531. Now remember, they pay out the dividends based on the number of shares you have, not the dollar amount you paid for them. So we want to buy the shares for as low a price as we possibly can and hang on to those babies, because they're going to pay these dividends based on the number of shares you own, not how much you paid for them. So you're going to get, let's say, 25 cents per share, whether you paid $50 for it or $10 for it. You're still going to get your 25 cents. It's better, obviously, to pay 25 cents for them and get your $25 for them instead of $50 for them. Pay less for them. That's the goal. You want to buy these shares at the lowest price you can. Buy the dips. Buy the dips. All right. So 3,531 shares is what we have. And I'm going to put that into my calculator. 3,531.07. 3,531.07 times. See, you guys come to do this live. This is a live thing. This is not some canned response where I could do this in 2 minutes if it was all canned, but that's no fun. You want to come do it live with me, right? I hope you're updating your spreadsheet at the same time I'm updating mine. That's the whole idea. All right, so we got 3,531 shares. You see how I do it. So now we come in here and we're going to TSLY. And with track and trade doesn't do dividends, so we got to do them over here. All right, so here's dividends right there, 76 cents. So we go 3,531 shares, and they're going to give us 76 cents for every share. So we take 3,531 times 0.76. That means they gave us $2,683. So now we got to come over here, and we got to put in, where's Tesla? There it is. So that they gave it that. What was the date? I like to put the date. May 15th. So on May 15th, 05, 15, 2025, they gave us $2,683.61 on our $54,000 investment. Boom. All right. So they gave us 2006. That's better. The last month they gave us 2,300. The month before that, 1,600 because they were going down as having a rough month, right? Then they gave us 2,000, 2,500. So already data here. Do you want to replace it? Cancel. I'm not trying to do that. Okay, 2,683. That's good money. Let's come and put that over here. So Tesla, we're going to go like that. We're going to go equals 2,683, enter. All right. So now we got to go do NVIDIA. So far we made $9,000 in the month of May. May has been a banner month. We still got our two big, we still got NVIDIA and Palantir to pay out. And we've already made $9,000. In month of April, we only made $6,000. Month of March, we made $5,000. February, we made $7,000. How much? Well, $170,000 investment. This is all on $170,000. So far, we've made $9,000. We're not even done. Here, let me move me out of the way again. Oh, well, how am I don't know how the hell I can put myself and not be in the way in this one. There we go. All right, so now what we're going to do is we're going to come over here and let's calculate NVIDIA. So NVIDIA, how many shares do we have of NVIDIA? NVIDIA, we have 290 shares. So let's go over and see how much money they gave us. NVIDIA, NVDY. NVIDIA gave us in the month of May $1.62. $1.62 on May the 22nd. All right, so let's go back over to our spreadsheet. We have 290 shares, so we're going to take 290 times, don't forget the 53, 290.53 times $1.62 per share. They gave us $470. All right, where's NVIDIA? Right here. And they gave us that on 5/22/2025. They gave us $470.65. That's way better than last month. Last month they only gave us 193, and in January and March they only gave us 228. So that's a banner month right there, man. That's a banner month. Okay. Now we got to take that and put it over here. So we go equals this number here, enter. All right. Our number's getting so big, we're going to have to widen our screen. We just broke 10 grand and we haven't even done Palantir yet. How much do we have in Palantir? Palantir, we have 4,000. Oh, we've only got a small investment. We've only got 68 shares. Okay. So let's come over here. PLTY. PLTY. It's a 22nd again. They gave us $7 though. $7.04. Holy cow, $7. $7 a share. And we've got 68 shares times 68 shares. They gave us 478 bucks. 478 buckaroos. Where is that one? Where's Tesla? Oh, Palantir right here. So that was 5/22/2025, and they gave us $478.72. $478.72. We're going to put that right here. So we go equals that number there, enter. So we have received on our $170,000 investment. That's how much we put in on January 1st when we started this little portfolio here in our YouTube portfolio. And we have received, we don't have a grand total, do we? So we received $10,767 this month alone on a $170,000 investment. Now that's what I call UBI, Universal Basic Income. And actually I'm going to call that, I'm going to go with Elon Musk. That is Universal High Income, UHI, Universal High Income. That's $100,000 a year If we were able to get $10,000 a month, when of course we're not. We got 6,000 last month and 5,000 the month before that, 7,000, then 7,000. Oh, here's our total right there. No, that's not our total. What is that? It does say grand total. That's not grand total. That's grand total. How come I'm not able to make that work? Because the stupid spreadsheet's not big enough. Hold on, I got to widen that. Come on, let go of it. Let go. Let go. Are you guys big spreadsheet guys? I'm not a big spreadsheet guy. I try to be. I dabble in spreadsheets. Okay, $38,000 so far this year. That's our grand total. We've made $38,000 in 1, 2, 3, 4, 5 months on a $170,000 investment. Now, you can't complain about that. Now, maybe you can, but I don't want you to. That's taking profits along the way. Now, we've put $170,000 in, and in 10 years, when you're ready to retire, there's not going to be a great big huge pot of gold sitting at the end of the rainbow. You have to understand how these things are designed. There is not going to be some big pot of gold waiting for you at the end of the rainbow. If you buy Microsoft and you hold on to it for 20 years, there will be a big pot of gold at the end of the rainbow, or at least that's the theory, right? The theory is that if you buy it and hold it, when you're ready to retire, there will be a big pot of gold at the end of the rainbow for you. That's not what this is. If that's the kind of trading that you're looking for, don't do this. All right? That's not what this is. You're not going to have a big pot of gold at the end of the rainbow. Why? Because they're giving you little pots of gold every month, taking profits along the way, giving them to you. Now, you can take those profits and reinvest them and do something else with them. We've taken $6,000, that's $10,000. You might not need $10,000 to live on. You might need more than that to live on. I don't know. But the point is that we put $170,000 into these yield max funds. We pulled $10,000 out just this month alone. And we can take that money and do whatever we want with it. We can reinvest it, go put it in Microsoft if you want, and then let it ride for 10 years and see where it is in 10 years. You can do that, all right? But the idea is that it's taking the little pots of gold out every month and giving them to you, so there will not be a big pot of gold at the end of the year. Take profits along the way. But if you buy your Microsoft stock today and it goes way up, and then for some reason, and I don't know why this might happen, but the stock market might go down, which it never does, right? My stock market never goes down. We just had a big down, right? So let's say it goes way up, goes way back down, matches the price where you put it in. You make nothing over a 10-year period of time. But had you taken profits along the way, you'd have had all these little pots of gold along the way, and you'd have had your money. That's the difference. Is one better than the other? No, they're just different. Everybody says, which is better, Lan? They're not better. There's no one's not better than the other. They're just different. Now, in 20 years, you might be able to look back and say this one would have been better than that one, but hindsight's always 20/20. Nobody ever makes any money off of hindsight, right? So you can say, well, that would have been better had I done that. So you can look back in time and you can say, well, I would have been better off this way over the last 10 years, but that doesn't mean anything going forward. You don't know what the next 10 years is going to be like. So you can use past performance. Past performance is not necessarily indicative of future results, right? But it's the best we got. So we use past performance. But current performance is what you're seeing here on the screen. This is how this thing's played out so far. We made $10,000 right here this month on a $170,000 investment. Is that, could you have made more somewhere else? I'm sure you could have, had you played it right. But this is pretty simple. You just put your money in, they trade it for you, and then give you the money. I don't know, makes it pretty easy. I like it. All right, let's go look at my real money account. So we're going to pull up my real money spreadsheet, my UBI. It's always a little nerve-wracking when you pull up your real money account. Where is it? There it is. All right. So right here, you can see these are my totals. These are my estimated total payments. So you can see this is my real money account. In January, I made $29,000. In February, I made $26,000. In March, I made $27,000. In April, I made $30,000. And in May, I made $52,000. So far, January, February, March, April, May, 5 months, I made $166,000. This is my real money accounts. Now I'm going to come down here and show you the bottoms. So this is where we're coming in here. This is where the infusion, this is how much money I put in. So I have my parity. All right. So I trade for parity. Now I'm not, it's beyond the scope of this class today, but parity means that I want my accounts to stay close to how much I put in. All right. If I put some in and the market goes down, I lose my net asset value. I try to build my net asset value up to a certain level. I'll put more money in. If it goes over my parity, then I don't do anything usually. I can take that money out and put it somewhere else. That's the idea. So you can see my parity in here. So this is parity. I'm $270 over parity. I'm $16,000 over parity on this one. I'm $6,000 under parity on this one, which means that my NAV is dipping $6,000 below parity. All right. So this one is down $2,900. So I'm $2,000 below parity on that one. This one here, I'm $3,000 below parity, and that one is YMAG. This one, I'm $2,800 below parity. Doesn't mean I don't get my shares. I do. And to bring it above parity, there's two ways I can do it. I can just wait because they'll pay me some dividends, and the dividends will raise it back up and put it back up above parity, right? Or actually, no, that's not. The dividends won't unless I reinvest them. And since I'm not reinvesting in some of these, it won't bring it back above parity. So for example, I don't do a lot of reinvesting back into YMAG. I don't think I put a lot of money into YMAG. I've got, how much have I got in there? In YMAG, I have $56,000. It's currently worth 46. So the NAV has gone down $3,900 below my parity, 46,000. So it's down $10,000. They've given me in dividends $8,000. So that's why I'm below parity on that one. Okay. But this one here, $1,663 above parity on Tesla. Now that doesn't mean that's a profit. That just means I want to maintain the NAV at $110,000. So if they give me the dividends, I don't put them back in. I put them somewhere else, or I reinvest them something else. That's just how much money I put in. I put in $132,000, and I want parity to be $110,000. So I'm at $1,600 above parity. That's what that means. All right. This one, I'm $21,000 above parity. That one's YBIT. So I'm $21,000 above parity, more than what I wanted that to be. But that's my dividends right there. That's what it's paid out, $166,000. This is my real money account. This is a little bit different. Total parity, I'm 7,600 over parity. So that's just tracks my NAV. And then my close hide. Total dividends is 115,000. So total infusion, I've put 413,000 into this one account. Like I said, I've got this account. I got traditional IRA, I got Roth IRA, I got SEP, I got HSA. That was the word I was looking for. Plus, I got my wife's accounts. So we've put money into all these, and most of this is I would say, well, this spreadsheet, all of this is all just tracking. Mostly, it just tracks the yield max funds. So that's how it's working. So you can see in May on YMAG, I got $1,900. On YMAX this month, I got $906. On Misty, I got $11,000. On Snowy, I got $3,000. On Tesla, I got $7,000. On YBIT, I got $8,900. And Palantir, my biggest one, for $12,000. And then NVIDIA for $4,000. So for a total of $52,000, that's what I made this month. That's real money. Real money. All right, guys, I don't have much else to teach you except for how to make $52,000 a month. And if you like that, stick around. Hit like, share, subscribe. I know that it was a little rough. I had a little spot where I turned off my microphone. Actually, I think I turned off my microphone myself. That's when I lost my voice and took a drink of water, wasn't it? Turned off my microphone, forgot to turn it back on. That's me. All right. If some crazy guy like me, John saying, how much did you, what, check PLTY on payments received 50,000? No, Palantir, I made 12,000 on an investment of 121,000. So I put in $121,000 into Palantir all by itself. Now this is the Palantir. Remember, I told you I put $100,000 into PLTR. I did. I had 100,000 in PLTR. I also had 100,000 in PLTY. So I had 200,000 in Palantir. But one was in the underlying, one was in, and then on the underlying one, I took the 100,000 out as it went up. Remember, I sold some of that out. I only have about $25,000 sitting in Palantir proper, but I still have my 121,000 over here in PLTY. I didn't ever sell that out. I kept that, and that just gives me my dividends. So I take the dividends and then I put them into other investments. And one of the things I put them into is PLTR. And then as it rose, I bought low and took profits along the way and sold out. So I only have 25,000 left, but that's not in this sheet because that's not one of these yield max funds. Does that answer your question? Oh, on the class portfolio. So what were you asking about the class portfolio? Let's get back over to that one. Okay. So right here, what were you asking on PLTY? Yeah, we only had our investment or seed money on PLTY on this one is only $4,300. That's all we have in there. Is that what you're asking, John? Check Palantir on payments received 50,000. No, in this one we have 4,000. And did I make a mistake? PLTY. It's clear over here. No, we made $478. So if we come over here, it's $478, $10,000. I think that's right. Palantir in the demo account version, we only have $4,300. Now we've made some money. So we can take this and put it into something else. So this, I've just making notes on where we've been putting our money. We were playing a little bit over here and we were saying, well, we have, we bought a four-wheeler, we bought a Harley motorcycle, we got in our, we haven't bought the Harley yet. We haven't bought the four-wheeler yet either. Tesla, we bought a Tesla. So we have to take like money out and pay our Tesla every month. I have to give our wife a present. Land's Pheasant Ranch. I went to the Pheasant Ranch. My sons come to the Pheasant Ranch. So I was just spending some of the money. And then whatever we had left, we take and reinvest. I kind of ignored this little spending money thing in the interest of time. But it's more interesting just to know that, well, we made 10 grand in dividends. All right. That's it, guys. That's what I got for you today. I do have a Sunday school lesson for you. And I thought this was a little bit apropos for the day. Don't be a jack of all trades and a master of none. Specialize in one or possibly two types of trading strategies. Consider short-term day trades and then maybe some long-term options. Cover both bases and do what works for you. So I like these yield max funds. They've been working really well for me. I know they get a lot of bad press. Nobody out there likes them. I love them. And I think the reason they get bad press is because the people who don't like them don't understand them. They're new. They're something that we've never done in the stock market before. It's never been done. It's like a single stock futures. We did those over in the single stock futures world. Never been done. And it didn't last. It went away. Nobody traded them. This is something I think these guys are going to stick around. They're really popular. They even opened up in Europe. People are trading them. There's a lot of YouTubers that don't like them. You're going to get a lot of bad press out there because they don't understand them. They don't understand what a single stock ETF is. It just, their brain hasn't registered it and they haven't done the work to go in and find out what they're doing and why and how it works. They don't understand options trading, most of them, because they're mostly investors. So they're not traders. They don't come from the world of trading. They come from the world of buy and hold. And so they don't like these funds. I don't get them. Scary, unknown. Only been around 2 years. But if you understand the core concept of what they do, they're amazing. Right? They're trading options for you. That's what they're doing. And no, it's not free money. They're busting their ass. They're taking some big risks, and they're trading options. And anytime you're trading options, you're taking extra risk. So, they're pros, and they're good at it. Probably better at it than maybe you can trade. Right? They're good enough at it that they've started a big company that's on Wall Street being traded in the New York Stock Exchange. That's pretty cool. I mean, I'm not trading a company that's New York Stock Exchange. These guys can trade options better than I can. So I'm like, I've been trading options my whole life. Well, not my whole life, but I've been trading options a long time, and pretty good at it. I think, had a lot of, I teach options at the university. I mean, I'm pretty good at options, and I'm giving my money to these guys because I think they can trade the options better than I can. They're pretty good options traders. Does it mean they're perfect and you're going to make money every single time? No. They lose money sometimes. Everybody loses money sometimes, especially when you got a position or a strategy that's meant to go long. You make money when markets go up. So if it goes down for 3 months, it's really hard to make money. All right. So don't complain about NAV going down in these markets when you got to compare it. Compared to what? Compared to the underlying, which tanked and lost everything you made. So, it's all apples to apples and apples to oranges. You got to be, they're nice. They're really nice. I like them. I'm not telling you to invest in them. I'm just telling you what I'm doing in them. And I think they're really nice. And if you understand them, and if you don't understand them and you would like to understand them better, get Pitt News Magazine. I got a course, and I don't want to be Mr. Course Salesman, but I do have a course that teaches you all about this stuff. And it's mostly Pitt News Magazine articles that we've written over the last, year since we've been doing these, that I've put together into a course, and you can go watch the course. And I made little calculators and all this really neat stuff. And I'm not trying to sell it to you, so I'm not going to even, if you want it, my email address is lhturner at, actually, how are you going to contact me? My email, I hate email. Email doesn't work. Call my AI assistant at 435-512-0722. And you'll get my AI assistant. She'll pick up and she'll say, "Hi, I'm Lan Turner's AI assistant. What would you like?" Say, "My name is this, and this is my phone number. Have Lan call me. I want to talk to him about his course. It's not expensive. I don't charge like $1,000 for it. In fact, I haven't even put a price on it. I've been giving it away for free, but I probably ought to sell it." Put a lot of work into it. It's not ready to sell. Maybe I'll set it up and sell it. I don't know. It's just a course that I created, and I just do these live seminars, and I did it for the live seminars that we were been doing. So that was part of the live seminars. I don't know if you want it. Heck. How do you get to it? Here, I'll give you the link to it. It's free. You don't even have to call me. Let me just give it to you. I'll give you my course. I want everybody to have it. I don't care. I made, what did I make here? Why do I care? I made $52,000 this month. Why am I trying to sell anything? I don't care. I don't care. I made $52,000 this month. I don't care. You can have the course for free. All right. I don't know how to get to it. Let's see. pitnews.com. pitnews.com/UBI-course. Oh, that's really hard. There it is. pitnews.com UBI course. If you come to my live seminars, this is the course that I use. All right. So that's the URL right there. You want it? There it is. pitnews.com/UBI-course, and you're going to get this little course. It's all about these yield max funds. They're just articles from Pitt News Magazine, past articles. Go click on them, and they got audio recording, and you just listen to them, and then you can read the audio. So there you go. Just for sticking around and hanging out with me for an hour and a half. Way too long. I went way over class. So there's your free bonus for did that work? I don't even know if that worked. That didn't work, did it? Remove this. Go back to here. See, it's that stupid program again. All right, I'll bring it back up one more time. Let's try this one more time. Did it work? Did you guys see it? I don't think you saw it. Here, there it is. There's the URL right there. Let's go see. Oh, yeah, it's working now. So there it is, pitnews.com/UBI-course. That's what you get for sticking around till the end of class. Free course, Universal Basic Income course and calculators. All right. And the spreadsheet. That's the spreadsheet. That's the spreadsheet that we've been working off of for the class, not the new one. The new one I haven't given out yet because it's not done. All right, guys, that's all I got for you. We're going to let you go. Subscribe to Pitt News Magazine. That's all I have to say about that. Oh, one more thing here. One more thing.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
All right, there we go, guys. Take care. We'll see you next Tuesday morning.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.